Germany, June 1921 to November 1923. Highest monthly inflation rate, over 30,000%. Time required for prices to double, every few days. During World War I, like many countries, Germany, then called the Weimar Republic, suspended its gold standard to fund the war effort, based on the belief that they were going to win the war and pay for it by plundering their enemies. That plan obviously didn't work out, so after the war, they were left shackled with not only their own war debts, but were also fined 132 billion gold marks in reparations by the Treaty of Versailles, the equivalent of about $269 billion today. The first payment of that war guilt came due in June 1921. The problem was the treaty didn't allow Germany to make payments in its own currency, so Germany had no choice but to exchange their German marks for other respected currencies at really bad exchange rates. So what was the solution? Well, we're off the gold standard, so let's just print more money. And print they did. That printed money was used to buy foreign currency, that foreign currency was used to pay off their war reparations, and soon Germany was buying foreign currency at any price because why not? All they had to do was print more money. So in just a little over a year later, the German mark was already practically worthless. A $50,000 bill turned into a $500,000 bill, to a $5 million bill, to a $50 million bill, to $500 million, to $5 billion, to $50 billion, to $500 billion, to $5 trillion, to a $50 trillion bill. Bills that were worth more of its weight as wood fire than as a medium of exchange. A loaf of bread that cost 160 marks by the end of 1922 skyrocketed to 200 billion marks just a year later. Although Germany was the most infamous case of hyperinflation, it is far from the worst. This episode is brought to you by Trends. Learn about thousands of great business ideas that you can take advantage of long before you read about them in the Wall Street Journal. I personally enjoyed reading about the massive growth around apps popping up on Slack's platform. Who would have thought that Slack apps would grow into a $300 million market? Stay tuned to the end to learn more, or feel free to discover your next big idea right now by going to trends.co/JakeTran. Try out Trends for an entire week, all for just $1. Again, that's trends.co/JakeTran. The link is also in the video description below. Hungary, August 1945 to July 1946. Highest monthly rate of inflation, 4.19 times 10 to the 16th power, or this giant number. Equivalent daily inflation rate, 207%. Time required for prices to double, 15 hours. After World War II, like many countries, Hungary was left in shambles. Their industries were crippled, and what remained of their assets were seized by both sides of the war. So the amount of goods produced went down, but the amount of money in circulation stayed the same. So, inflation. But instead of trying to reduce the inflation by reducing the amount of money in circulation, which could have made the already dead economy worse, Hungary took a different approach. The government intentionally caused inflation by printing literally as much money as they could. What started out as 25 billion penge in July 1945 grew to 1.6 trillion penge 6 months later. Then just 4 months after that, the money supply grew to 65 quadrillion, which is a million billion. Then just another 2 months after that, to 47 septillion. That's 47 trillion. To make this a little bit more comprehensible, something that cost 379 penge in September 1945 went up to a trillion 10 months later. At one point, the government had to stop collecting taxes, because if they were late by just 1 day, it would have wiped out the value of the taxes the government collected. Needless to say, this would go down in history as the worst case of hyperinflation ever. Yugoslavia, April 1992 to January 1994. Highest monthly inflation rate, 313 million%. Equivalent daily inflation rate, 64.6%. Time required for prices to double, 1.4 days. Yugoslavia was a nation born in the wake of World War II that was made up of these modern-day countries. During the early days of the breakup of these nation-states in the early 1990s, the second worst case of hyperinflation occurred. Far worse than the Weimar Republic, yet it seems to have slipped under the public's consciousness. At its peak in January 1994, the official monthly inflation rate was 313 million%, or 4 times higher than the Weimar Republic. And the results were devastating. People's income dropped more than 50%, they couldn't afford food if there was any to be bought, bread lines, foreign gas stations were closed, foreign exchange black markets emerged. To put it into perspective, imagine the money you have in your bank account right now, then imagine moving the decimal point 22 places to the left. Then imagine trying to buy something. Then imagine trying to survive through this for 2 years straight, from the start of 2020 to the end of 2021 for example. Zimbabwe, March 2007 to November 2008. Highest monthly inflation rate, 79.6 billion%. Equivalent daily inflation rate, 98%. Time required for prices to double, 24.7 hours. After Zimbabwe gained independence from the United Kingdom in 1980, this opened up a whole new profession: politicians. Politicians whose first priority has always been to secure those votes to secure their seat in power. And how do you secure that public support as a politician who has control over the government spending? Offer free stuff. So offer free stuff they did, which created a spending problem for their government. Add on top of that a ton of other stuff like the government seizing farms from white farmers and giving it to black farmers that didn't know how to farm, which created a food shortage.
The situation was made worse by costly participation in the Congo War in 1998 and sanctions against Robert Mugabe's government in 2002.
The government blames its financial problems on sanctions imposed by the EU and US during Mugabe's reign.
The banking sector collapsing and the money printer going burr, and you have the perfect storm to nurture some hyperinflation. The general rule of thumb is that hyperinflation is when the monthly inflation rate is above 50%. And since 1998, Zimbabwe has been hovering around a 50% annual inflation rate. Mix in Zimbabwe's central bank continuing to tinker with the economy to try to slow down inflation, and by March 2007, the country was experiencing full-blown hyperinflation, with again it peaking around 79.6 billion% a month.
Prices in shops would go up several times a day, water and power cuts happened often, and there were queues at banks, petrol stations, and severe shortages of food in supermarkets.
A problem they're still struggling on and off with to this day.
This year, inflation is hovering at around 300%. That was the latest figure before Zimbabwe's finance minister put a moratorium on publishing numbers until next year.
Venezuela, 2013 to today. A situation caused by both political and economic reasons that range from the government controlling parts of the economy, shortages of food, electricity, medicine, riots and political instability that stem from that, oil revenue tanking even though they have some of the largest oil reserves on the planet.
Gasoline has been in short supply there for years. The shortage has now reached unsustainable levels and is hitting the capital Caracas in the middle of a pandemic.
Economic sanctions from the US and more, with hyperinflation starting at modest levels in 2013 to peaking at around 1.6 million% in 2018, with the Venezuelan central bank estimating that the currency was inflated by 53.8 million% between 2006 and April 2019.
There's no coffee, no flour, no oil, no butter, no cornflakes. There are a lot of food products missing that aren't luxuries, just normal food.
They were able to tame the hyperinflation back down to better levels in the low thousands of percents in recent years, but that still means that for the average everyday shopper on the streets, prices for goods are doubling every few weeks. One woman said, "Everything is rising so quickly that what I deposit in my account doesn't buy anything. All we can do is eat less and stretch what we have." Which brings us to today, in the West. The United States, January 6, 2020 to January 4, 2021. Coming straight from the Fed, we started this period with around $4 trillion in the system. 1 year later, that number is at $6.7 trillion. Meaning that over 40% of all US dollars were printed in just the last 12 months.
Well, we've had an incredible surge in government spending. A lot of it related, of course, to COVID-19 and to the ordered, economic shutdown and the fact that a lot of people were no longer out there earning money. And so the government looked to replace what people were no longer earning by printing money, which is what they did. You had all this government spending, but there were no additional tax hikes to cover the cost, nor did the government try to prioritize any of its spending. It didn't say, well, maybe we should spend less on the military so we have more to spend on fighting the pandemic, right? They didn't budget their resources. They just said, well, we're just going to spend more money on the pandemic, but we're not going to spend less on anything else, and we're not going to raise anybody's taxes to pay for it. So where'd all the government spending come from? It doesn't come from, thin air. The money has to come from somewhere. And if they're not going to make room in the budget by cutting spending, if they're not going to increase taxes to get additional revenue, well, then they just crank up the printing presses. So that's where all this new money came from. The government printed it, and spent it into circulation through all these programs.
And from the looks of it, no one seems to be in a rush to slow things down.
A sweeping nearly $2 trillion relief package to tackle this pandemic, one of the largest in our nation's history.
In fact, no one is really talking about this at all.
And right now, nobody seems to think that this is a problem. People seem to think that we've stumbled on the equivalent of a monetary fountain of youth. People like to call it modern monetary theory, which is we can have whatever we want as long as government prints the money to pay for it, that there's no limit, that government is free as long as they print money. Now, of course,
and strangely enough, we haven't seen much inflation for everyday goods like gas and food. Prices definitely haven't gone up anywhere near 40%, and other countries seem to be following suit. So the question remains, where's the inflation? The reason why we haven't seen inflation yet is because the amount of money being printed is only one of the factors that contributes to inflation. To get inflation, here's everything you need. Number 1, industrial output. How much stuff an economy makes. The more stuff, the more supply, which equals lower prices. The less stuff, the higher the prices. Number 2, employment. Too much employment leads employers fighting over workers, which leads to higher wages, which leads to higher prices. Too little employment leads to employees fighting over jobs, which leads to lower wages, which leads to lower prices. Number 3, the money supply. The main topic of this video and probably the easiest to understand. The more money in an economy equals higher prices, as long as the economy is producing the same amount of stuff or less stuff. And number 4, if the money is exchanging hands, and if so, how fast, also known as the velocity of money. If you print a bunch of money but that money is spent on food instead of gas, food is going to experience inflation, but gas isn't. If you want a more detailed explanation of this, I highly recommend you watch the video by Economics Explained on the subject. It will be linked below. And in our case right now, the money supply has shot up a ridiculous amount, but the other factors have been keeping inflation down. Industrial output, it's been down from businesses not being able to operate, which leads to less stuff. But there's also less demand from you and I to buy those things, so its impact on how much inflation we have is kinda neutral. Employment has also definitely taken a hit, and with less employment comes lower wages, which means lower prices, not inflation. And the velocity of money. It's pretty slow for everyone with all the uncertainty in the air. People don't want to spend money right now if they don't know if they're going to be able to keep their job or find a new one.
And I think the reason for that is a lot of the money that we print, as is always the case, ends up getting exported. If you look at our trade deficits, they surged to record territory, especially in goods, where we had all-time record high trade deficits. So a lot of that money got exported, and it wasn't here in the US where it would have been used to bid up the price of goods and services.
But you know what they are going to spend money on? Things that only go up, like Tesla stock, every other stock, real estate, and Bitcoin. So we are seeing plenty of inflation happening right now. The S&P 500 has seen around a 70% increase since its crash in March, the same exact period all these new US dollars were printed. Home prices have gone up by 8% since January, which is higher than usual. And pretty much everyone and their mom knows how well Bitcoin has been doing. But instead of calling it inflation, we call it the stock market rally, the real estate boom, crypto's time to shine, or the great crypto bubble, depending on who you ask.
when inflation pushes up asset prices, people don't complain because the people that own those assets, of course, feel much richer.
Right now, the downward pressures are counteracting the upward pressures, and we are in a fragile equilibrium.
So inflation can work its way into the economy through various methods, and so prices can be affected in different ways. But ultimately, it's consumer prices that are where all the inflation ends up once it, finishes making its way through the economy, because that's really all everybody wants. I mean, people don't buy stocks because they want to own stocks. They buy stocks because they think they'll be able to buy more consumer goods with the profits from their stocks. But ultimately, those profits have to be realized, and then they have to be spent on consumer goods, and the price of those goods can go up.
Which begs the question, should the money printer keep going burr? Can it keep going burr?
And I ultimately think we're going to see a real shock in terms of how high consumer prices are going to rise.
So you think that's how it's going to end up with all this money printing? It's eventually going to hit consumer prices?
Well, it always does. I mean, that's like the final resting place for inflation is in the end product, which is in consumer goods. But
those on the side of printing more and more money, spending more and more money, and not worrying about how much debt we have, the modern monetary theory camp, have an interesting argument. Their main thing is that since the government is the issuer of money, the creator of money, they don't have to worry very much about spending a lot, having too much debt, unlike people and businesses like us who are the users of money, because they can always print more to make the debt payments.
The line you want to draw between the federal government, let's say of the United States of America, and everybody else, that line that distinguishes their fiscal capacities, their spending capacities from ours, is really down to the fact that they can issue our currency, the US dollar, and the rest of us can't.
If a government issues its own currency, imposes tax liabilities or other kinds of liabilities in that currency, spends only in its own currency, and issues debt only in its own currency, then it basically can never run out of money. That is the basic of the argument.
With the only limit to how much money the government can spend, borrow, and print being the amount of stuff there is out there for the government to spend money on.
The limit would be the resources available for the government to hire or purchase. The government can't run out of finance, right? But the United States could run out of resources that are available.
Once that supply gets low, then we'll see prices rise and inflation rise. And if that's the case, we can spend, borrow, and print a lot more than where we're at right now before there's too much inflation. Assuming that's true, then we have a social responsibility to offer things like the government guaranteeing everyone has a job, the Green New Deal, stimulus checks, whatever.
The one that MMT is most associated with is the Job Guarantee Program, an unconditional, universal offer of a job to anyone who wants to work.
And the fact of the matter is, this is kinda how the world works right now.
People think that we're describing a new policy. We're not. We are describing reality. We're describing the way the US government spends, the way the British government spends.
But should this be how the world works in the first place? Should we just accept that the government should have a monopoly on money in the first place?
One way to think about it is the government has a monopoly on a certain thing. And so then why don't we get rid of that, right? If the government right now, Soviet Union, if they had a monopoly on agricultural output, there'd be an economist in there who could, his career would be writing books about proper Soviet planning of government, agricultural targets and so forth. But surely you would think that the right thing to do for the economist would be to focus on let's change this system. I don't understand why he's focusing on certain things and just conceding, yes, the government's going to have a monopoly on money and so forth, and that's the way it is. If any other entity did the sorts of things and then tried to justify them or just explain what they were doing the way in his writings he talks about what the government's doing, clearly that would be fraudulent. And the fundamental way that he came back and said there's a distinction here that you're not getting, Murphy, is that it's like there's a scorekeeper. And obviously, there's a distinction between the people playing the game versus the referee setting up the game. But then that just begs the question, why are we playing this game in the first place? Why is that guy the scorekeeper? It's because they have guns and are pointing them at us and saying, you're going to play this game is because you're going to get shot otherwise. All right. So since neither of us is describing the way the world literally is right this second, we're both explaining tweaks we want to make in this system. It seems to me that's kind of a big deal.
Our brains have not evolved very much in the last 10,000 years. That means that the same humans that caused all the other examples of hyperinflation, those same politicians with the same incentives that led to those disasters, are the same humans in our government today, with similar incentives. Are those really the people you want in control of the printing press?
So before this interview, before this video, I really tried to understand the other side of the argument, the modern monetary theorists. On the surface, it kind of makes sense. What are your thoughts on it?
Well, it doesn't make sense beneath the surface, and it doesn't make sense on the surface either. Like, no matter where you go relative to the surface, it doesn't make any sense. But what is true, though, is that if a government borrows in its own currency, yes, it can go deeper into debt before suffering the consequences of its profligacy than a country that's borrowing in somebody else's currency that it can't print. So the day of reckoning will come later for a country that's borrowing in its own currency. But because the day of reckoning comes later, the problems get much bigger before that happens. So that means the ultimate consequences are much more severe. So you get away with it for a little longer, but then the pain is worse when you no longer get away with it. Because the idea that you get away with it indefinitely is nonsense, right? The bills have got to be paid eventually. And the longer you procrastinate paying them, the bigger the bill's going to be.
But when the government just prints money and gives it to you, right? When you have all these unemployed people who are sitting at home just getting a check from the government, they produced nothing. They added no goods or services to the economy, yet they can consume goods and services in the same proportions as if somebody had actually done work and actually been, a productive member of society. All this does is drive up prices, because if your work adds to the goods and services, and now you're consuming the goods and services you help create, that's fine. But if now you start consuming goods and services, yet you didn't help create any of those goods and services, you just have more money chasing a diminished supply of goods and services, and prices are going to go up. And they're going to go up like never before. And the irony of all of this is that the Federal Reserve has been promising Americans more inflation. Well, that's one promise that they're going to deliver on. In fact, they're going to deliver on it beyond their wildest expectations.
When you give government power, they usually don't like to give it back. So do you think there's ever going to be a time where they're going to slow down the money printer, or is it just going to continue forever?
Well, they can't do it forever, because at some point the money has no value. And, there's not much sense in printing money that buys nothing. So at some point they're going to have to turn off the presses. And in fact, hopefully at some point they're going to slow them down quite a bit. But, we'll see how long they can resist doing that, because doing it involves a lot of pain, short-term pain, economically, politically, that our leaders really don't want. And of course, if you look at all of the promises that they've made to the voters that can't possibly be paid for, rather than admit that none of this can is affordable, they can just print the money and act as if the government can provide these things. So given the type of leaders we have and their philosophy and the base, there's a good chance that they're going to push this as far as they can. I mean, until the dollar has completely collapsed, and then they just can't get away with it anymore. So before that happens, there's really no incentive for anybody to change.
Yeah.
Because as long as they can print money and people will accept it and the value doesn't go down too much, well, they'll just keep doing it, rather than being honest with the public and accepting the consequences.
One of the best ways to protect yourself against inflation and even hyperinflation is to have a great business. Because if you have the next big thing that people need, you'll be protected in any business environment. That's where Trends comes in. With Trends, you can discover emerging industries before they become a big deal. Just head over to the Signal section and feast your eyes on the latest trending sectors like niche sports or psychedelic mushrooms, which are being used as a potential treatment for depression. In addition to being the internet's most undiscovered knowledge hub, Trends is also home to a wonderful community. A community of makers, investors, and not to mention hustling entrepreneurs just like you and me. If you run a business or you're thinking about starting one, Trends is a must-have resource. Discover your next big idea by starting your 1-week trial of Trends for the grand sum of just $1 by going to trends.co/JakeTran. The link is also in the video description below. Oolong tea and MCT oil. Not sponsored. Peter Schiff, the guy you've seen featured in this video. Super cool guy, someone that I really like to listen to and take into account his opinions, along with other people who have differing economic opinions, so calm down, especially you Bitcoin boys. He's the guy in the video that you've probably seen around, I Am the 1%, Let's Talk, and he's got a great podcast and YouTube channel that you can check out with the links below. Alright, I am well aware that there are a lot of plugs in this video, but this plug is very important. I decided at the last minute to post the entire interviews I do for these videos on a separate channel for you guys to check out, because it's not like I have a lot of stuff on my plate or anything. So you can check out the entire Peter Schiff interview with the link in the video description, where we talk about a ton of cool stuff. Like, is it inevitable that more capitalistic, individualistic societies naturally decay into more socialistic, collectivist societies? That would be linked below, and it would mean a ton if you guys subscribe to that channel too. Back to the other me. If you are new here, we make video essays just like this one every single week on the most thought-provoking, controversial, interesting subjects in the world of business every single week for free. So make sure you subscribe to this channel too with the red button below. I believe that's gonna wrap it up for this video. Thank you so much for watching. You've been awesome. I've been Jake. Stay dangerous out there as always, and I will see you guys in the next one.